We're talking inflation, macro, monetary policy, and Bitcoin with Dhaval Joshi. He is the chief strategist of Counterpoint at BCA Research. Welcome to the show, Dhaval. I've spoken to a number of your BCA colleagues already. I'm very happy to have you on the show today.
Thanks for the invitation.
I read your most recent report from Counterpoint, and I want to touch on your paragraph or your section about inflation. You wrote that inflation is driven up by durables and durable spending over the last couple of quarters. Can you expand on that?
Sure. I mean, we've had a sort of an unprecedented imbalance in the economy. I was focusing on the US economy, but this is really a global phenomenon whereby we have had this massive overspending on goods at the expense of services for obvious reasons. That, you know, if services are unavailable, you're in lockdown, your incomes have been supported by massive fiscal stimulus. What are you going to spend that money on? You can't go out to bars, clubs. You don't even go to the office in some cases. You don't go on vacation. So we've been spending a lot of money on goods, and the overspend relative to the pre-pandemic trend was 26%. That's sort of unheard of in economic history. And the key point is that manufacturers of goods, they can barely produce a few percent more than trend. So if you're at sort of 26% above trend, then you're going to have severe inflationary pressures. And of course, you're going to have supply problems as well. So a lot of the sort of supply bottlenecks, they are very real, but they have been caused by this super demand. Mm-hmm. So what we can see is that there is a very good sort of causality between the spending on goods and inflation. And you can actually see it in the monthly data, that when you've had these little surges in goods, you tend to have these surges in inflation, and they've actually been three surges. It's not one; it's three surges.
Right.
And essentially, what I'm really saying is, once that durable spending demand eases back, then we should get a natural cooling of inflationary pressures.
Okay, that leads me to my next question. I'm looking at data from the St. Louis Fed. This is the personal savings rate from the U.S. During the pandemic, during the few months in 2020 when we had an official recession, the savings rate skyrocketed to multi-decade highs. It very quickly came down, and now the savings rate is not only at pre-pandemic lows, but is lower than pre-pandemic lows. So I guess this coincides with what you said about savings on durable goods and other things. Now, my question, Dhaval, is that given the low savings rate that we have now, people might be a little bit, tight on money or capital in their bank. Do you see aggregate demand slowing down as a result of the depletion of personal capital?
Yeah. So the thing about the savings is that we had this, as you correctly pointed out, a big sort of surge in the savings rate. So in terms of accumulated savings, people did, as an economy, we did accumulate a lot of savings. But the question is are those savings, those accumulated savings, available for spending money now? And so I'm talking about the savings that we've accumulated over the last couple of years, rather than what we're saving today, if you see what I'm saying.
Yes.
And the sort of the bullish argument is, look, we've got all this sort of accumulated savings which we can unleash. But I would push back against that. Because I would say that what happens is once those savings sort of move from your sort of income account into your wealth, the propensity to spend them drops very, very sharply. So there's a lot of sort of behavioral finance in this, which is that once, if you get a stimulus check, it's in your monthly, it's in your checking account, you're prepared to spend it. But the moment it gets moved into your sort of 401k or your savings account, your propensity to spend it drops very, very, very sharply. So that's why that's why sort of bottom line in all this, I don't think we're going to see a big surge in spending just because we accumulated savings. That to me, I think I would push back against that argument.
Okay. So you don't think there was a correlation between the savings rate and the higher savings rate last year and the year before that and the spending on durable goods that you cited?
So there was the connection is really between the waves of stimulus combined with lockdown. That's where so you've had several waves of restrictions combined with several waves of stimulus, and that's what's really that correlates with those surges in demand for goods.
Well, Dhaval, okay, so in the U.S., then we've had 7.5% CPI, headline CPI. You mentioned earlier in the interview that you expect inflation to eventually cool down. Let me posit a counter argument by some economists I've heard, and I'd like you to respond to this. Monetarist cite Milton Friedman and quote him by saying that inflation is always and everywhere a monetary phenomenon, and even though you're right that supply chain bottlenecks could be eventually fixed, we still have an unprecedented amount of money in the system. M2 is still at an all-time high, and until that comes down, they argue inflation is unlikely to follow and come down as well. How would you respond to that argument?
Well, I kind of agree with it, but the part of the money supply we should be looking at is credit, bank credit, and not M2. So it's the amount, it's the money that's really available in the economy out there to be spent. You shouldn't include the amount of money supply that's kind of locked up in the banking system. So I think M2 gives a sort of a false impression of that.
Yes.
So if you look at purely what's happened to bank credit, you do not see the same explosion in money supply. That would be my response to that.
What about the credit impulse? Is there a relationship between consumer prices and the credit impulse?
Normally there is, but remember that what happened in the pandemic was that the stimulus was not really coming through the sort of bank lending channel. It was really coming through fiscal stimulus. So the typical relationship between the credit cycle and the spending cycle became much, much weaker. So eventually that will return, but we're still in the pandemic era. We're still seeing the impact of huge waves of stimulus, huge waves of fiscal stimulus, which are now receding pretty much everywhere in the world, because the point is those stimulus, the government was prepared to engage in this unprecedented stimulus while we were in this sort of pandemic crisis, and now they're trying to wind it down.
Yes.
As we so-called normalize, and that's the hope, that we do normalize. That's the good news, that we are going to sort of come to some sort of normalization in our lives. But then the quid pro quo is that you're not going to get supported by the government anymore. Mm-hmm. But there's one other point I want to make.
Yes.
If I may, which is that the other side of this, the thing that complicates it is that there's a big chunk of service sector spending which is not normalizing. For example, recreational activities, public transportation, physician services. So we are in a kind of a new world where we are doing things more sort of remotely. We're doing this sort of hybrid home and office working. We're not commuting as much. We're doing much more online retail, and we're doing online doctor's appointments, right? So what I'm really saying is that the durable spending is going to drop because we've bought so many durable goods. We sort of front-end loaded that. But a lot of the service sector spending is not going to normalize back to the 2019 level or the 2019 trend. And that's where we could have a bit of a problem. Certainly, in the next second half of the year, I think there could be a real problem that we have a shortfall in demand.
Okay. Now, I want to touch on monetary policy now. But before that, what is your outlook on inflation? So again, 7.5 is the latest reading. We have the BLS reporting data pretty soon in March. What are you expecting for the rest of the year?
Well, I don't know about the exact timing, but I would expect the sort of the monthly inflation rates to start coming down. And in fact, if we look at the monthly rate, we are still, and we did get this other sort of, we got a pickup recently, but we did not get to the level we had about a year ago, where the monthly rate, I think, peaked at 0.8%. I think we're now running at 0.6%. I mean, this is still much too high, because 0.6%, is a sort of annualized rate of whatever, 7% or so. But this peak is still lower than we were a year ago. So I would expect those monthly rates of increase to be sort of gradually coming down by the second half of this year, but not, probably not to 2%, not to 2%. But of course, this will also depend on what happens in terms of other geopolitical, the geopolitical shock that we're experiencing right now. So that will be another factor to consider. But, putting that to one side, I think we would expect inflation to be coming down, though, as I say, not quite to 2%.
Inflation, if let's assume that your forecast is correct and that inflation does come down naturally by itself anyway, keep in mind that the Fed hasn't officially hiked rates yet. They've tapered their bond purchase program, but they haven't hiked rates yet. So is it still necessary to hike rates, Dhaval, given that inflation is, per your forecast, going to come down anyway?
Well, I think that in a way, this is more about the credibility of the Fed than about economic policy. So I think it's very difficult for them to essentially say, and sort of position for a rate hike, and it's taken them months and months and months to get here, and then to suddenly do a sort of a major reverse is a credibility problem. So I think that absent some sort of major shock between now and the March meeting, they would have to raise rates just to sort of maintain credibility. And if they want, and what they can do is certainly talk down the number of hikes that they expect to engage in over this this year or so. But I think it'd be they're thinking not just of the economy and the impact of short-term rates. They're thinking about their credibility. And that's why I think that it's difficult to back down.
What's your outlook on the number of rate hikes? Is there a number that you're comfortable sharing?
Well, I think what I would say is I think the market's expectation is too high.
Okay.
That's the way I would put it. But the other thing I would point out is that we sort of obsess about, whether the Fed is going to hike, 4 times, 6 times, 7 times. I think it's largely that to me is sort of missing the point, because I think what's much more important for the economy, but also for the stock market, is the bond yield. It is the bond yield is really, and especially the 30-year yield, not even the 10-year. The 30-year is really the key, and the 30-year is already coming down. It did go up. It got up to around 2.4%. In the recent rise, but it has started to come down. So the thing I'd be watching much more closely as regards the feedback into the economy and to financial assets and the stock market is the 30-year bond yield. That is by far the more important driver compared to the Fed funds rate.
You have a chart here that shows that the 30-year is, driven by inflation. I guess, is it a leading indicator or a coincident indicator for inflation? Which drives the other?
Well, recently it's been the sort of the evolution of inflation, including this unexpected new surge. Because I think everyone was saying, look, a year ago, inflation is transient. It's going to be gone within a few months, within 6 months. And when that, initially the 30-year did come down, as you can see, if you look at the chart. But then we had this sort of this second wave of inflation, and that's what's caused the long end to move up again.
Sure.
So that's where the causality is. It's this idea the transient narrative proved to be wrong temporarily, let's say.
Right.
That's where the market got surprised.
What do you think has changed in terms of monetary policy from the recent developments in Ukraine? Do you think war in Eastern Europe, which a lot of people didn't really expect to happen, people have been talking about the risk of invasion, but I think I've spoken to several people and that invasion caught people by surprise. Do you think central banks around the world are surprised?
Yes, because I don't think that a sort of full-scale invasion was expected by anyone. I think the most that people were expecting was a sort of a more sort of surgical, let's just say, move into some of the sort of eastern provinces, the sort of Russian-speaking provinces. That's what the sort of expectation was. So a full-scale invasion was not in the price, and of course the response from the West was not priced. And that's where the threat comes from now in terms of the economy, which is that, look, sanctions hurt both sides, right? Because what you're doing is you're restricting trade, you're restricting financial and economic activity. And by definition, it's a sort of symmetrical process. It may not be perfectly symmetrical, but the person who applies sanctions is going to get hurt as well as the person who is being sanctioned. Mm-hmm. So we are going to see the impact of sanctions. Is there's going to be a sort of it's going to be demand destructive, and so the impact will be, in a way, it'll be sort of stagflationary. The initial response, the initial impact on energy prices is higher, but of course it's going to be demand destructive. So the question we have to ask is, how will central banks respond to that sort of stagflation thesis? I think that, generally speaking, if it is a sort of energy-driven inflation, central banks look through it, and they'll just say, "Look, we're much more worried about the demand destruction that's going to happen." So that obviously that's much more of a worry for Europe than it is for the US. It is a worry for the US as well, but less so.
Is it fair to assume then, Dhaval, that the ECB is going to put on pause any plans for future rate hikes? And if the Federal Reserve beats them to the punch in terms of hiking rates, can we see a strengthening of the dollar vis-a-vis the euro? Is that too far of a stretch? It could, but there's another driver of the euro, and or let's just say the dollar, which is just the sort of risk off. If you get a big sell-off in the markets, which we haven't really had, we haven't had that big sort of crash, let's just say. We've had a weakness in markets. If there is a sell-off, that is very supportive of the dollar. That's really to do with capital flows, not just bond flows, but equity flows, because typically the US is kind of seen as a haven market, and that's why the dollar rallies during these sort of crises. So that would be one reason why the dollar would rise as well. It's not simply to do with monetary policy; it's to do with the sort of the haven status of the dollar. So. And of course, relative monetary policy would also be dollar supportive. I see. Now, I just want to bring up stocks real quick before we close off on Bitcoin. It was interesting to me, Dhaval, on the eve of the invasion of Ukraine on the 24th of February, when the New York markets opened at 9:30 a.m. Eastern, stocks rallied. Actually, that was surprising to me. Can you explain why? Well, it's really difficult to. I mean, I think that it's really hard to explain sort of short-term moves in the stock market. The market has been. Well, let me put it another way. When a country as big as Ukraine gets invaded, is that typically positive or negative for equities? All else being equal.
Well, I think that I guess the initial positive, I would say, in the first few days, the West really dithered and balked at applying sanctions. And the key sort of transmission mechanism which is going to hurt the economy is through the energy flow between Russia and the West. And on day one, and even really until about sort of day 3 or 4, the West was really dithering about applying aggressive sanctions.
Yes.
But now they have started to be much more aggressive on the sanction front as the war has escalated. And that's why you're starting to see weakness in the market. And it could continue as things escalate.
All right. I want to close on Bitcoin, and specifically, there's a lot to talk about with Bitcoin, but I just want to narrow down on Bitcoin's use as an inflation hedge. Is that even possible to conceive of Bitcoin as an inflation hedge? I'm going to give you two arguments. One I've heard from the pro-Bitcoin side and one I've heard from the anti-Bitcoin side. The pro-Bitcoin side argues that since inception in 2009, Bitcoin has outperformed all the other major asset classes, stocks, gold, bonds. even real estate. And if you actually not even take a look at absolute returns, but on a risk-adjusted basis, the Sharpe ratio that Bitcoin has been higher than all these other asset classes by a considerable margin as well. So if you take a look at the entire history of Bitcoin, yes, it's hedged inflation very well, more so than any other asset class. The counter argument to that is that Bitcoin doesn't follow the CPI on an annual or even monthly basis. In fact, there's been years in the past when Bitcoin's down 80%. So medium term, it doesn't hedge against inflation. Long term, certainly it has. What's your view?
Yeah, so the thing is that it doesn't, if you want a hedge against inflation on a short-term view, let's just say over 1 year, even a couple of years, it's not really going to work. That's not what it's designed to do. The way I would think about Bitcoin is it's kind of like a hedge against a breakdown of the monetary system, or a devaluation of fiat money. In other words, what you're really saying is, look, if I'm worried that the US is going to become like Argentina, or Turkey, then what you want to do is you want to have an investment that is completely disassociated from the US government and central bank's ability to devalue it. So that's the way to think about it. It's kind of like an alternative to gold. And it's a digital gold, but it doesn't correlate with gold on a day-to-day basis either, right? Because the point is that you've got this sort of gold market and you've got this new kid on the block, which is the crypto market, and people are sort of trying to take, you're displacing some of the sort of gold investments with crypto. So that's why it's not going to correlate with gold either on a short-term basis. But what I would say is the way to think about it is a hedge against the US or the UK or Europe sort of going down the way of Argentina or Venezuela, right? Mm-hmm. That's the way to think about it. If you're worried that that's going to happen. And the point is, as an investor, you do have to have this sort of insurance policy. Just as if you have a house, I insure my house against a hurricane, even though I don't expect the hurricane to happen, right? I still have the insurance policy. So as an investor, you have to have an insurance policy against this extreme scenario of a complete debasement of the dollar. And for that, crypto is a viable asset, just as gold is. It's just that you got the two choices now. I can either do it through gold or you can do it through crypto. And some investors are sort of taking the decision to have a bit of both.
Final question, I'll let you go. Given what you've said about Bitcoin, are you surprised at all that Bitcoin has, in the last year at least, been trading very closely with the NASDAQ? In fact, if you plot the Bitcoin price over the QQQ, which is the ETF that tracks the NASDAQ top 100, you'll notice a very close correlation. Can you explain the relationship there? And do you think there's going to be potentially a divergence in the future where Bitcoin just starts trading by itself and not correlated with any other asset class?
Yeah, so I think that ultimately there is a connection between Bitcoin and its underlying technology, which is blockchain. So it's not just Bitcoin; it's Ethereum, Solana, Cardano, whatever. They are. In many cases, the success of the coin depends on the success of the underlying blockchain technology, and therefore. As sort of hopes for the blockchain, as optimism for the blockchain increases, you tend to see a rally in the coins, their respective coins, and vice versa.
Yes.
And they are highly volatile. That they are. It's a sort of it. I'm saying it's a gold equivalent, but it's a much more volatile. So you have to sort of you can own it, but you've got to sort of position size it accordingly. But to answer your question, it's because, there is a connection between the success of the technology and the success of the coin. And I would also say that a lot of the people who are open to the idea of owning cryptocurrencies are the very same investors who will invest in the NASDAQ and those types of growth companies. So that's the other reason why there has been this sort of short-term tight connection.
All right. Very good. Dhaval, I appreciate your thoughts on inflation and Bitcoin and monetary policy. I hope to see you again. Thank you very much for your thoughts.
Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.